Okay, everybody, this is a video based off of my notes off of my website, markrosa.com. You would go to bonds and a link would come up, bond notes, and you're clicking that, and then all of my notes on the subject comes up. There is a space that I'll flip to in a second that is going over the four bond yield calculations. And what has to be done here is somebody that's interested in investing in bonds needs to basically know what that investment entails, meaning what's in it for you. That you're going to loan a company money. We know that bond investing is debt of the issuing firm. So you and I are loaning the company money, and we talked about bond ratings so far and so on, but we didn't get into the calculations, and that's what this video is about. So I could switch over to a new share here. Sorry about the pregnant pause. There we go. Okay, so this is off my website, and you just scroll down here with the bond ratings. We talked about those, and you're coming down to bond yield. So I put this warning out there because it just over time, I'd mentioned to you all in class that people are getting the simplest things wrong, and it just doesn't bode well for them from a testing standpoint. And I put this big yellow, it's very dramatic and kind of in your face, but yeah, I was just trying to call the right amount of attention to these calculations because finance is a very quantitative subject, and we have to evaluate things quantitatively to understand what their value is. And again, finance is a very value-driven discipline where we're not worried about price. We know what the price is. We're worried about what the investment is worth. So these calculations are going to help us navigate some of this. Let me take down this. Okay, so when we're looking at these four bond calculations, here they are, typed everything out. So I'm going to introduce these, and I'm going to switch back to uh, the Microsoft Word sheet so we could I can mark on it. So here's the coupon rate and the coupon yield. So we were talking about that in class. That's the given. Okay, it's stated on the face of the bond. That's the given. If it's a coupon rate of 8%, some people will call it a coupon yield because we're calling the rest of these yields. So those tend to get used somewhat interchangeably. So you got a coupon yield, current yield, yield to maturity, and yield to call. So I've got the formulas here, and I'm going to switch back to the Microsoft Word. Okay, so we can get started on this. All right, so same thing here, coupon rate or yield, current yield, yield to maturity, yield to call. A couple of things before we get started, very important. Test questions. Interest rate risk is the biggest risk of bond ownership. Default risk is the second biggest risk of bond ownership. It's not so much, those things are not so much attached to this video on yields, but since we have something, I'll post it on my YouTube channel. It's under Mark Rosa. You type that in and it'll come right up. And these are big deals. These are kind of overriding truths that we have to understand about bond investing. So when we're going into this, a couple of things I'll say here, and I'll explain it more as we're going along, but just let me get it on the recording to say interest rates and bond prices have an inverse relationship. What does that mean? Well, when something's inverse, one is going up while the other one's going down and vice versa. So if interest rates are going up, I'm going to just lazily do an I right here. Bond prices are going down. Bond prices. Okay. Now, so far, before we got to this, we were understanding, let me come over here and say again things that we should know by now. What do we have as a bond face value, par value or face amount? We have the $1,000. So because that's written on the face of the bond, we knew that before. So what happens, guys, if somebody borrows money like Ford or Amazon or whomever, and Wall Street puts together a bond issue for them, Well, these bonds are going to come out of the printing press, and I use that figuratively. They don't print them anymore, but they're going to come out where on the bond's face is going to be that $1,000. So brand new printed bond just coming out. You go to buy it off the secondary market, meaning through your broker, and that's what it would basically cost you. But these things are out there for 20, 30, 40, 50 years. Ford has a 100-year bond out there that's going against the convention of the bond market, but companies do it. You know, they'll go to Wall Street and say, look, I want to borrow some money and I want it to last 100 years. So if Wall Street puts it together and it sells, I guess that's what gets the company the money that they need to build, in Ford's case, build a new plant or revitalize a plant, or, you know, a new plant for electric cars or whatever they're trying to do. And that money is loaned to the company for 100 years to whoever borrows these, whoever buys these bonds, money that the company is borrowing. But what happens is you have market fluctuations, just like a stock. So what sells at $1,000, and let's say it was an 8% coupon, okay, that reflects the interest rate or the rate of return that the market is expecting today. When I say today, it's more generally stated what the current environment is. It might be a low interest rate environment. That was a couple of years ago. I'm making this on September 27th, 2023. So just a couple of years ago when COVID hit in 2020, interest rates went down very, very rapidly because the Fed was lowering interest rates, trying to stimulate the economy. And we'll talk more about Fed when we get a little further down. And now that the economy is going gangbusters and inflation is in the equation, the Fed is raising interest rates to try to lower inflation. Well, what happens here is, let's say the current interest rate in the market is 8%, and that's why Ford is borrowing money at 8%. Okay, that makes sense. But if the Fed raises rates to 10%, okay, and you and I could buy a 10% bond, because the next company that goes out and tries to raise money, they're going to be issuing 10% coupon bonds. Well, what happens to this? Well, we're not as interested anymore. Okay, we don't want to buy an 8% bond and get $80 a year when 10% bonds are very plentiful, because companies are borrowing money at the current interest rate, the interest rate that after the Fed has changed those. And now that this 10% bond is out there, existing bond prices fall, because we're not interested in buying this 8% bond for $1,000. So would you buy it for $900? Maybe so. But the point is here that I'm trying to really emphasize is these move opposite each other for reasons that I said so far this morning. And really what has to happen, guys, is if you're getting, if this is, you know, $1,000 bond at 8%, well, we know it's going to be $80 a year in income. So it's $80 a year over 1,000. What we're doing is we're calculating the coupon rate. It's $80 a year over $1,000 investment is 8%. Okay, so we're just getting back to this. But if interest rates have gone up, people say, I want a 10% investment. Well, we're not going to change the coupons of the bond. Those are out there forever. So what basically Wall Street is saying is you have to figure out getting $80 a year, and what would you be willing to pay for this to be 10%? This calculation is easy, 800. Okay, so there you go. That's what the bond would have to fall to. Its price would have to fall from 1,000 down to 800 to give the purchaser a 10% return to match what is happening in the marketplace. So overnight, Fed raises rates, bond prices fall, and to keep these in line, to keep an older but existing investment in line with a new one that might be printed today. So that's the concept behind this. What is this? I am describing interest rate risk, the risk that interest rates change. And they are going to change. They're going to change over time, because interest rates aren't going to sit still for 30 years while some bond is ready to mature. And you got bonds going on the market all the time. You got bonds coming off of the market all the time. companies are borrowing money like you and I would borrow money. We're not worried about, what time of the day it is and so on. If you're ready to buy your car and you want your car financed, okay, you're going to borrow it, and you could shop around what the rates would be and do those types of things. But, people buy cars and they finance them. So do they buy fewer cars when interest rates are very high? They do, but some cars are still, somebody needs their car and they go and finance it. So that's what this is. So interest rate risk is the biggest risk of bond ownership. Default risk, the risk that the company will not pay you back and go into default and maybe file for bankruptcy, and then your bond investment is wiped out because it's debt of the firm. You loan the company money, the company can go bankrupt, and then you won't get paid. Why is default risk less? Well, it's very unusual for these large multinational companies to file for bankruptcy, but it is more routine that the Federal Reserve, the U.S. Federal Reserve Bank, is out there moving interest rates around. Okay, that's more routine. That's more just as a normal course of business. That's a normal course of the business cycle. That's a normal course of what they do. So that's why interest rate risk is the biggest risk. That's a test question for sure. And number two could be also. So we need to understand both of those. All right, let me clean this up and give you another. All right. The other thing I wanted to mention, and I'll switch to another page and kind of show you, I found a mistake, believe it or not, on FINRA's page, and that's the Financial Regulatory Authority, and shame on them for making this error, but I'll point that out to you when we get to it. The other thing, when we look at how a bond is stated on the market, okay, so it is, and this is the important part, it will be stated, a quote. It will be a quote, not a price. Price has a dollar sign in front of it, and that's the error I want to point out to you. But a quote will be placed in terms of a percent of the par value. That's how the bond market works. All right. So to go further here, we got to know what par is, and we know what par is. It's $1,000. Okay. So if I would say that I'm the broker and you call me and said, look, I'm looking at a bond here. It's a Ford bond or an Amazon bond or whomever, and I like what I see. Can you give me a current quote off the internet or off the broker's what's called a Quotron system? And it's like, yeah, it's trading at a quote of 90. That's how the conversation would go, and I'm teaching you that how the bond market works. Okay, so 90, you would be saying 90. Wait, that doesn't make any sense. I'm buying a $1,000 bond, and what's 90? Well, it's 90% of par. Okay, that's how the bond system works. So we would say 90% of 1,000 is 900. And that's what, now we could put a dollar sign in front of it because we've done the math. We've done the quote, the percent of par, multiplied it by 1,000, and we come up with the actual dollar price. So I could put a dollar sign in front of it. So if a bond was trading at 65, well, that's $650, right? Because it'd be 65% of 1,000. And if you did this on your calculator, it would be $650. All right. So interest rates, so why would a bond trade under its par value? Because what the more likely thing is something happened to the company. Maybe they're doing poorly financially and their bond prices started to fall. Or what could have happened? Something happened in the market where the Fed raised interest rates, and of course the bond prices would fall, as we spoke about just a few minutes ago. And while we're here, I have to tell us if the bond is trading at a price below par, it is said to be trading at a discount to face. That's a way to say that, discount to face. What is the face value? Face value is the par value. We've been over that, okay? And these terms are used interchangeably. That's just how the bond market works. So you could see on, programs or movies or anything that talks about Wall Street, this is the language that they use to describe this. Now, what if interest rates had fallen? Well, if interest rates are going down, that means bond prices are going up, and we could have a bond trading for a premium to face. So what would that look like? Well, if I'm the broker, you call me and say, I have a bond that I'm looking at, and can you give me a quote on it? Yes, it's trading at 110. Okay. And we would say, wait a minute, that doesn't make any sense. 110, what does that mean? $110 and I'm getting a $1,000 bond out of it? No, it's 110% of the par value. So if you want to do the arithmetic on the calculator, this is selling at $1,100. Okay, premium to face. And incidentally, guys, while people are buying, like the face value is the sticker price. If you want to use a car vernacular, you go on a car lot and you say, well, you ask the dealer, how much you asking for this car? And they signal that. They don't have to say a word. They signal that by putting a sticker in the window, if you're familiar with that process. And you look at the sticker and it says on the bond, it's on the face of it. So they say, we're selling this, this is worth $1,000. And then you start asking about price, you go a little bit further. And sometimes, we've known over time, and I've known over time that some dealers on some cars, they'll sell them at higher than sticker. They want a premium for that car, depending on what it was. It's a new model that came out. A lot of people are interested in it, and they can get away with it. So they will price them at a premium to face or premium to sticker on the car vernacular. Let's stick to bonds though. So that would be a premium. So if you bought this bond and paid $1,100 for it, when the bond matures, Ford or Amazon or whomever is going to give you $1,000 back because that is on the face of the bond. You're going to say, well, I'm going to lose $100 on that investment. That's exactly what's going to happen. The company is not going to pay you for the premium. The company has no idea that you paid over $1,000 for this investment. That was your doing as the investor. You choose to do that. And just telling stories, I remember when I had my broker's license, I'd have people call and say, okay, I'm a bond investor. I want to buy some bonds. Look for bonds that, let's say, are non-callable. People would give you, people that are a little bit more knowledgeable about the market, that would tell you, I want non-callable bonds and I never want to pay a premium. Okay. So that means you're either buying it at par, meaning right at $1,000, or you want to buy the ones at a discount. It's that simple. Okay. So some people say, I don't want to pay the premium because I don't want to lose that money when the bond matures. Because the company is going to see that bond, right? Drawing my little crude bond, and over here is the principal or the face value, and it's got $1,000 written on it. That's what they're going to pay you when this thing is due. All right, so I needed to say that because we're going to go into a couple of things on these bond calculations, and what we said so far this morning is necessary to go through this. All right. So we have 4 bond calculations. We have coupon rate, we have that, and I'll show it to you in a second, just kind of setting the stage. Then we have the current yield, yield to maturity, and yield to call. So let's advance this and go to the first one. All right, the coupon rate or the coupon yield is the mathematical proof of what is given on the face of the bond, something that we've been studying already. So example of a coupon rate, it's the annual interest divided by the par value. So I have said, and what I wanted us to continue to do, as soon as you see a coupon rate, guys, you got to multiply it by 1,000, and you get, in this case, you'd get the $80, okay? And that's $80 is the annual interest. Okay, we know how this relationship would work. So if you took 8% of 1,000, you would multiply these together, and it would give you what? $80. Okay, so 1,000 times 8% is 80, and you've got, this is the mathematical proof of what's going to go on if you bought this bond at par, at $1,000. You're going to get $80 every year. And what does that equate to? That equates to an 8% return. Okay, so we got the picture. We see what's on the face of the bond. We understand this, so that's the idea of understanding this completely. And then the bond, and off it goes. It goes out into the market and starts trading, okay? And it starts moving up in price, and it moves down in price, and it moves up in price, and it moves down in price. This goes on. So let's come down and see what would happen when the bond price is changing. Well, now we need another calculation. We need the current yield. Current yield, by definition, is the annual interest divided by the bond's current price in the market. All right, so I'm going to give us an example here. Okay, example. If the 8% bond, that's $80 annual interest, right? We've got to come off. We've got to know that right off the bat. If the 8% bond is trading at a quoted amount of 106, as per our previous discussion, the quote translates into a bond price of 1060. All right, because that's 106% of the par value. If we bought the bond at this premium to its face, we would expect our yield to fall. So let's see. So, okay, we have let me draw this. We have the 8% bond. So that means $80 annual interest, because here's the calculation that we're doing, divided by the bond's current price. Well, what is it? Well, it's trading at 1060. Okay, you're going to get $80 a year until the bond matures, and you chose to buy it at a premium of 1060. So if we did this calculation, what would we have? And I did it for us, 0.0755. I'd encourage you to do that on your calculator. Pause the video. And this is 7.55%. That's simple. Okay, why did we get a hit? Why did we take a hit? Because if we bought it at par, we would have said $80 over 1,000. This is 8%. We didn't buy it at par. We paid more. We paid $60 more, $60 that is going to be lost if you hold this bond to maturity, because $1,000 is going to come out the other side of that. The company is going to pay you the $1,000 back, not the $60. You chose to buy this at a premium. So we have to have a calculation that reflects that premium. Okay, so we would be earning 7.55% on this bond for years to come. I don't have a maturity date in here. That's not so important on the current yield. Guys, it's a simple calculation. It doesn't capture much data, but it does capture why there is a different calculation for it. So current yield, we're reflecting the annual interest divided by the bond's price. And that's what we have to remember here. So we took a little hit, and somebody might say, well, you know what? I want this for whatever reason. It fits in my portfolio. I like what I see. I know it trades at a premium. That's in front of my face, but I'll go ahead and do it. I'll pay the premium because this rate might still be good. I missed the 8%. You know, that's back when the bond was selling at its par value. I missed that. I waited too long, and the market moved. Maybe interest rates fell in general, and the bond price popped up about $60. And it's like, well, this is worth it for me. I'm not worried about the $60. I'm worried about the 7.5% that I might get for 20, 30, 40 years. So that 60 at the end of 30 years doesn't mean that much to me in current dollars. I'm not worried about it, but that's how the calculation would go for current yield. All right. So let's move forward. Coupon yield and current yield are easy calculations to make. It's our annual interest divided by, in the coupon yield, divided by par. Annual yield over the current price is current yield. And guys, those are just ratios. So if we wanted to get more specific, which we have to do because this isn't enough information, what we would do is go to what's called yield to maturity. All right. So looking at my notes, this is a more comprehensive analysis to see what the bond's investment actually returns to the investor. The formula is longer because it takes in more information than the previous two calculations, ones that we just mentioned. So yield to maturity, I have this in my notes, okay? And here's the formula. So it looks imposing, but it's not. You know, we could fill this in. So let's let's go through the pieces and we'll understand this a little bit better. All right, yield to maturity, or what's a lot of times referred to as YTM, is the annual interest plus, I need to open brackets, open paren, par minus price, we'll come down here and do this, okay, divided by the number of years to maturity, okay, within the brackets, close the brackets, and this whole thing is divided by par plus price averaged over 2. Okay, sounds like a mouthful. Let's go into it. Given that an 8% bond, okay, oh, we got a coupon rate. So it's the moment I see a coupon rate, I do 8% of 1,000 is 80, and it gives me the annual interest, and that's a sloppy 8. And while we're at it, we could say, well, they're going to pay us in semi-annual installments. We know that, so this is annual, and this is semi-annual, right? SA. But we saw that coupon rate, so that's what I encourage us to do. As soon as you see that, understand what's going on over here. Just set it aside. So given an 8% 30-year bond with 11 years to maturity and selling for a quote of 109, calculate the yield to maturity. So guys, right here will be the equivalent of a test question. That's all I have to give you to do this calculation, and the rest will be up to you. So let's look at, and we'll be looking at this while I'm doing it down here. All right, so it's annual interest. Your 8% gave you the annual interest. So you would say 80, okay, plus open bracket, open paren. What is it? Par minus price. So par, we know what that is. It's $1,000 minus the price. We got a price quote right here of 109. So that's 109% of 1,000, which is going to be 1090. Close paren right up here. Divided by the number of years to maturity. So what does it have here? Given an 8% 30-year bond with 11 years to maturity, we're going to put divided by 11. And I'm going to close that bracket, okay? Then this is going to be divided by par plus price over 2. So right in here, I'm going to do the same thing. It's got to be a plus 1,000 plus 1090 over 2. There it is, yield to maturity. So I've got it here, wanted to replicate it below. And if you're doing the calculation, which I would encourage you to do, you're going to get a 6.87% yield. So guys, this is obviously more moving parts, but the yield to maturity captures the loss right here. This is a minus $90. Okay, that's what you're going to lose in 11 years. Because you bought the bond for 1090, or you're thinking about buying it for 1090, and it's going to mature at $1,000. So that $90 is going to be gone. You're going to get your $80 every year for 11 years, okay? Years to maturity. And here's the calculation. So you would get a 6.87% yield, and then you would have to decide, do I want this or not? If yes, you would buy it at a premium, knowing what it's going to do, knowing how it's going to end, and this would be your yield. So people want to know, and again, going back to broker days, people would call and say, give me the yield to worst. That's a brokerage term, something that you don't have to know. But what we would do is we do all 4 of these calculations, or what anybody would do that's actually looking at this thing. They would do all 4 calculations, pick the lowest one, and then say, this is the worst that would happen. That would be yield to worst. But I'm going to show you what happens next. So here we go, yield to maturity, a little bit more of a calculation here. You'll have to know the formula for test 2 in the final, because you'll have this on both tests. And here's the formula. It's in my notes, and it's on this video. Okay. All right. So what would happen, guys? We got 11 years to maturity, but let's say this bond is callable. Well, what could happen? Well, a company could pay it off. And if they paid it off more quickly, then it's years to maturity. Well, let's say, they could pay it off in 3, 4, 5, 6, 7 years. Well, we're going to be cut short of the annual interest. We're only going to get 5 or 6 years of annual interest. We're going to take this loss more quickly. And I don't know about you, but if you're facing a loss, you would never want to take it. You would say, well, let me take that when I'm dead, way, way into the future. But if the company calls it or pays this thing off before it matures, they are going to send us the $1,000. Okay, they're not going to send us this. We've been over that. And your yield would be impacted. Well, what's that going to look like? Well, let's see. All right, so given this bond right here, so let's go down to the next sheet. Yield to call, more comprehensive analysis to see what the bond investment actually returns to the investor, given a callable bond. The formula is longer, okay, not longer than yield to maturity. It's the same thing as yield to maturity. Formula is longer than the first two yields because it takes in more information than, not to, I should change that, not the previous two calculations, the first two calculations, meaning coupon yield and current yield. Okay, my bad on that. I got to change that. All right, yield to call, you're noticing that the formula is exactly the same as the previous one, except you're not putting in years to maturity, you're putting in the number of years to call. All right, so let's look at this. Imagine that given an 8% 30-year bond with 11 years to maturity, and it can be called in 5 years. It's selling for a quote of 109. I kept everything the same from the previous calculation. And I'm saying calculate the yield to call. Well, here's the calculation, the same as before. I swapped out the 11 and I put in a 5 because that's what I'm told to do. Okay. And then I do the calculation. We don't have to do such arithmetic below here, guys. Y'all could put this in your calculator. And you would come out with a yield, if you did that right, meaning no keystrokes, it'd be a 5.9% yield to call. That's what you'd tell yourself as you're looking at this as a potential investment. That's what you'd tell your client. That's what you would tell your boss. If you're doing this for work, okay, it's got a, you know, the bond's got an 8%. Let's go back to where we were starting. The coupon rate is 8. The current yield is 7.55. The yield to maturity was, I thought, let's see, we don't have to. Let's see, let's go back to it. The yield to maturity was 6.87. It's getting worse and worse, but you would need to know that. And the yield to call is 5.9. So, you know, that would be okay. You know, if this thing is called away, meaning the company would pay it off more quickly, we would have a 5.9% yield to call. And guys, I could set up a scenario where you would lose money. In some cases, the yield to call is a negative rate of return. You know, let's say you bought this thing and it was called the next day. Well, you would take an immediate $90 loss immediately. Okay, so even if you got 1 year's payment, which you're not, because you bought it today and it was called tomorrow, you're not going to get a full coupon. So this is not going to be out there. Okay, you're going to take a $90 loss immediately. And, you know, if you do that calculation, this would be a negative return. So that's why we do this. It's not so much just your return might be reduced, it might be eliminated. You might get no return off of this investment at all. Okay, so those are the 4 bond yields. Glad we went over those and captured those in a video. And this is what we would have to practice. And I do want to say, let me see if I could, 2 things that I had promised to look at. All right, if we go back to my notes, okay, if we go all the way down, now I know it's a distance. Okay, so let me show you. I'm going to fast forward. These are my notes on my website under bonds. So if we're coming all the way down, here are some bond problems that I would encourage you to do. Okay, so here's the quotations. What if a bond is trading at 86? Well, that's a quote of 86, and that's 86% of 1,000. So here's the answer, 860. All right, so we could do the bond quotes. Given the following bond listings, find the requested information. Here's an AT&T 6 1/8. There's the coupon rate. That's all. Excuse me. That's all I need to give you to start this calculation. Find the coupon yield. First, you take 6 1/8% of 1,000. That's $61.25, and you're dividing that by the 1,000 because it's a coupon. Okay, and you'd come up with the 6.125 rate. Find the current yield if the bond price is trading at 106. So you'd have to take the annual interest and divide it by what? 1060, because it's 106% of 1,000. Here are practice problems. I'd encourage you to do them. And if you're getting the answers right here, then you're in great shape because I'm giving you all the answers to those. All right, so something else I wanted to show you. All right, let's make sure I'm sharing this screen. So I went on FINRA, okay, corporate and agency bonds. We're going to study agency bonds. I'm going to put that under another video. And I put in Microsoft here, guys, and I said, show me the results. Give me the bond inventory for Microsoft. This is what people would do. All right, we would come down. If I showed you this in class, I'm going back to what I'm looking at here. So here's a Microsoft Corp bond. It's not callable. It's a corporate issue. Here's the coupon rate. That's $45 a year because I saw a coupon rate. I multiplied it by 1,000, and I wanted to get my annual interest. Here's the date it matures, October 1st, 2040, and it's a AAA rated bond. All right. So notice that I don't know what it's trading for. I don't know how much this thing is trading for. I have no idea what to pay for it. Well, they take care of us by saying you can click on this and it's going to come up where it's going to give you a price, but it should be a quote. All right. So Microsoft Corp, this is the one. Coupon rate is 4.5%. We saw that. Maturity date is 10/1 of 2040. We saw that. And we see that a yield is higher than the coupon. How come? Because it's trading at a discount. So FINRA, who I'm actually going to call about this, is putting a $sign in front of this quote, guys, and that is wrong. So I need to call them and tell them. So it's amazing what you see on the internet. These people are professionals to bring these prices to us. It's an investment-centric website, and people depend on this. So this is actually 92.24 as a quote. 92.24% of the par value. Okay, so if I did this arithmetic, it's trading at $922.40. And it's going to mature at $1,000. So this bond is trading at a discount to face. We're going to buy it at $922.40, and it's going to mature at $1,000. We're going to earn that extra income here as a capital gain. So it's what, $71.60 if I did that arithmetic right, but you're buying it at a discount. So that's why the yield is higher than the coupon rate. Okay, so if we did like a yield to maturity, this should be it. They're calculating the yield to maturity for you as you're looking at it very quickly. And that would be the math that's behind this. So this would be an actual bond listing on an actual website that provides that to people. And but again, they should, they changed up their website about a year ago, and they're putting things in a way that's confusing to people. So that's why I'm adding it on this video to make sure we understand what's happening. All right, those are the things I wanted to show you. And this will be the end of this video. And thanks for watching.